Park Sutton Advisors is a boutique investment bank and merger and acquisition advisory firm focused exclusively on the wealth and asset management industry. So we're the most active investment bank for RIAs, having completed 15 transactions in 2020 and just announced our 17th of this year, with plans to close more than 20 before year end.
Wealth management is incredibly of interest. It's a seller's market. Valuation and deal terms have continued to escalate. I would say across the board, EBITDA multiples are way up, such that most of the firms we work with are receiving multiples of adjusted EBITDA in the 10 to 15 times range, sometimes less, sometimes higher. I would also say much higher percentages are being paid at closing than in the past.
Look, growth is king. If your firm is growing, you are absolutely going to get a better multiple than somebody that's not. You know, if you have 500 million in assets, unless there's something really wrong with your firm or there are legal issues or something like that, if your business is halfway decent, you're probably going to get 10 times on an adjusted EBITDA, and then it just scales upward from there.
And historically, buyers were not willing to pay on those, future synergistic cost reductions. But given the competitiveness in the market today, they are, because they are actually real cost savings.
I would say, especially from three categories of groups, and that includes the private equity-backed RIAs, of whom there are quite a few and more, and that includes groups like Cerity and Hightower and Mariner, even Creative Planning. Banks are very interested in wealth management. It's strategic to their businesses, fits nicely with their private banking and commercial banking. Insurance and employee benefits groups who are very, very interested in the sector, and that includes groups like One Digital and SageView, who've bought clients of ours.
If debt becomes more expensive than these sponsor-backed RIAs that are, to a large extent, keeping the market super competitive, it becomes more expensive for them to do deals. And that, I think that's probably the number one thing that we've discussed at Park Sutton that could cause valuations to compress.
If buyers are going to expect there to be just a decline in valuation and lesser deal terms, you're looking at sellers just deciding to wait and not to proceed with their transaction. Remains to be seen, though, as some of this consolidation goes on, if there may be more of a pricing dichotomy, as the buyers are willing to pay the top multiples for the stronger properties versus everyone, which just seems to be a little bit across the board right now.
A lot of the decision to, for the time to stay really depends on each individual owner or partner's own, goals and objectives. And certainly there are people who sell and leave within a 12-month period. There are people who sell and, are still there 15 years later.
By doing a deal with one of these large RIAs backed by private equity, it's not only that you have an opportunity to, join a national player or offload the stuff you don't like, but essentially these private equity firms behind the large RIAs, they're pretty much all looking to return 3 times their invested capital over 5 years. So let's say your firm's worth 20 million, you decide to take 5 million in equity. Very good chance if you pick one of these groups, they're all these blue chip PE, that 5 million is very likely a tax-free exchange and could be worth 15 million over 5 years. So it means your business, which might have been worth 20, you really could be taking 30.